After years of saving, you finally buy your dream home and start picturing a peaceful future, until a non-renewal letter from your insurer shatters that vision. Suddenly, it's not just storms you're worried about, but a system that considers your neighborhood too risky to cover. Across America, this insurance crisis is accelerating. Major companies like State Farm and Allstate are pulling back, leaving homeowners scrambling as premiums spike and coverage disappears. And it's not only coastal cities. Inland suburbs are feeling the strain too. What once seemed like a safe investment could quickly become a financial burden. Let's step into the heart of this growing storm. Number 10, Minneapolis, Minnesota. We kick off our journey in the heart of the Midwest, where winters are brutally cold, but the summers are starting to hit homeowners in the wallet in ways you wouldn't expect. When you think of Minneapolis, snow and ice probably come to mind. But the real headache for insurers isn't winter at all. It's the storms that arrive in the warmer months. Violent, convective storms that unleash hail the size of baseballs and winds capable of ripping roofs right off homes. For decades, Minneapolis was considered a reliable, low-risk market for insurance companies. But climate patterns have shifted dramatically. According to a recent report by the Star Tribune, homeowners in Minnesota have seen their insurance premiums climb by more than 50% in just the past year, far outpacing national inflation. The story doesn't end with higher monthly payments. Data from the Insurance Information Institute shows that Minnesota now ranks among the top 5 states for hail damage claims, forcing insurers to completely rethink their approach in the region. Deductibles for wind and hail damage have soared, often hitting 2% to 5% of a home's value. On a $400,000 property, that could mean being responsible for $20,000 before your policy even kicks in. Local news reports reveal that major insurers are quietly refusing new policies in certain Twin Cities zip codes, pushing buyers toward high-risk state pool coverage as a last resort. A study from S&P Global Intelligence found that insurers' loss ratios in Minnesota recently topped 100%, meaning they were paying out more in claims than they collected in premiums. And according to Policy Genius, the average homeowner now faces annual premiums approaching $2,500, significantly higher than neighboring states. In my view, Minneapolis has become the new frontier of America's insurance crisis. While everyone watches the coasts, the Midwest is quietly bleeding money due to these unpredictable summer storms. If you own a home here, every season is a gamble, hoping your roof can survive the next hailstorm onslaught. Number 9. Denver, Colorado. Heading west from the Midwest, we arrive in Denver, a city framed by breathtaking mountain views, but hiding a sobering reality for homeowners. For years, Denver has been a paradise for outdoor enthusiasts, a place where nature feels just a step away. Yet the very landscapes that attract people here are now becoming a threat. The danger isn't just in the forests anymore, it's creeping into suburban neighborhoods. The Marshall Fire, which destroyed over 1,000 homes in mere hours, changed everything for insurers evaluating the region. Recent data from the Colorado Division of Insurance shows that 76% of carriers have scaled back coverage in wildfire-prone areas around Denver. This mass withdrawal leaves homeowners with fewer choices and much higher premiums. A report from the Rocky Mountain Insurance Information Association shows that average homeowner insurance premiums in Colorado have surged nearly 60% over the past 3 years. Money leaving your account every month without any tangible return. The risk is far from theoretical. First Street Foundation estimates that more than 80,000 properties in the Denver metro area now face serious wildfire exposure, and current market prices don't fully reflect this danger. Rebuilding after a disaster is equally daunting. Veris Analytics reports that labor shortages and rising material costs have pushed reconstruction expenses in the mountain region roughly 20% above the national average. That means many homeowners are dangerously underinsured. Local advocacy groups report that complaints over policy non-renewals in Denver skyrocketed by 175% in just the past year. Even residents outside the forested areas feel the impact, as smoke damage and flying embers drive insurance costs across the entire metro. In my view, Denver is a warning sign for urban wildfire risk nationwide. Fires no longer stay contained in the woods. They can sweep through entire subdivisions in the blink of an eye. Living here now means accepting that your most valuable asset could be sitting in a literal tinderbox. Number 8. Oklahoma City, Oklahoma. Next, we head south into the heart of the Great Plains, where the wind doesn't just move, it roars. Oklahoma City sits right in the middle of Tornado Alley, and while locals are tough and resilient, the financial reality of living here is becoming impossible to ignore. This isn't just about surviving the occasional twister, it's about enduring relentless, high-intensity storms that eat away at insurers' profits year after year. Insurance companies are growing weary of replacing roofs every 3 to 5 years. According to the National Association of Insurance Commissioners, Oklahoma consistently ranks with the highest homeowner insurance premiums in the country, often double the national average. Many residents now face annual costs exceeding $3,500, with older homes carrying even heftier bills. Bankrate reports that premiums in Oklahoma City have jumped 42% since 2022 alone. The situation is so unstable that several regional carriers have gone insolvent in recent years, forcing the State Guarantee Fund to step in and cover claims. That kind of instability rattles the entire insurance market. NOAA storm data shows that Oklahoma County has one of the highest concentrations of damaging wind events per square mile in the nation, and CoreLogic confirms that nearly every home in Oklahoma City is at significant risk of severe storm damage. Deductibles have shifted as well, with most now at 1% to 2% of a home's insured value. That forces homeowners to cover a substantial portion of minor damage out of pocket, essentially self-insuring for common events. From my perspective, Oklahoma City is a stark example of how geography can impose a permanent financial penalty. You can build a storm shelter to protect your life, but there's no way to shield your wallet from these skyrocketing premiums. On paper, the cost of living here seems reasonable, until you add in the staggering insurance bills. Number 7. Houston, Texas. Next, we leave the plains and head south to Houston, right on the humid Gulf Coast, a city where water is rising from every angle. Most people know Houston for its booming energy sector, but insurers see it as ground zero for unpredictable and devastating flood losses. The danger isn't just hurricanes rolling in from the Gulf, it's the sudden, torrential rain bombs that can linger over neighborhoods for hours, submerging areas that never flooded before. Rapid urban sprawl has replaced natural wetlands, leaving water with nowhere to go except into your living room. Homeowners in the Houston area are paying some of the highest insurance premiums in the country. According to the Insurance Council of Texas, average costs have nearly doubled over the last 5 years. And the shock doesn't stop there. The National Flood Insurance Program's Risk Rating 2.0 system is sending premiums up for thousands of Houston homeowners by roughly 18% every year until they reach the full actuarial rate, a compounding increase that can make holding onto a property financially impossible. Redfin data shows that nearly 30% of homes in the Houston metro face high flood risk, and the private insurance market is retreating fast. Several major insurers have stopped offering wind and hail coverage in Harris County, leaving buyers dependent on the state-run insurer of last resort, TWWIA. Policies there have surged by more than 50%, signaling a collapse of the private market. Flood risks in Houston are also being underestimated. First Street Foundation reports that over 200,000 properties face significant flood exposure that FEMA maps don't account for. That means a home that looks safe on paper could quickly become uninsurable after just one heavy storm. Local real estate sources report deals falling through because buyers cannot secure coverage for less than $5,000 a year. In my view, Houston has become a financial trap for the middle class. On Zillow, housing prices might look affordable, but once you factor in wind, storm, and flood insurance, the true monthly cost is far higher than advertised. Number 6. Los Angeles, California. Next, we cross the desert into the Golden State to visit Los Angeles, a city that has long symbolized the American dream but is quickly becoming an insurance nightmare. LA is facing an unprecedented withdrawal of insurance capital. While most people hear about wildfires burning in remote hills, the real threat has moved closer to the urban edge, putting millions of homes in the basin at risk. It's no longer a matter of if a fire will strike, but when. The headlines are alarming. State Farm and Allstate, two of the nation's largest insurers, announced they would stop writing new homeowner policies in California entirely. According to the California Department of Insurance, 7 of the top 12 insurance groups in the state have paused or severely restricted new business. This creates a supply and demand crisis, leaving homeowners scrambling for coverage from the few companies still willing to write policies. Enrollment in the state's FAIR Plan, the high-risk insurance pool of last resort, has more than doubled in recent years, according to KQED, reaching record levels. These policies are more expensive and offer far less protection. Standard home premiums in fire-prone areas now run between $7,000 and $10,000 annually. CoreLogic estimates that over 400,000 homes in the Los Angeles metro are at high to extreme wildfire risk, representing billions of dollars in potential reconstruction costs. Building in LA is costly, Veris reports. Construction labor and material costs are roughly 30% above the national average, making claims extremely expensive for insurers. Policy non-renewals have surged as well. Consumer watchdog groups report that zip codes in the Santa Monica Mountains have seen non-renewals spike by over 200%. In my view, Los Angeles is undergoing a permanent repricing of paradise. The era of affordable insurance in Southern California is over. If major carriers like State Farm cannot see a profitable path forward here, it's worth asking yourself whether investing your life savings in this market is really a safe bet. Number 5. Charleston, South Carolina. Heading back to the Atlantic coast, we arrive in Charleston, a city celebrated for its historic charm, cobblestone streets, and southern elegance. But beneath its beauty, the city is slowly sinking. Charleston has become the poster child for what experts call sunny day flooding. You don't need a hurricane to damage your home here. Sometimes, a high tide is enough. The encroaching water is forcing insurers to react with steep premium hikes and frequent coverage denials. According to the South Carolina Department of Insurance, coastal premiums have jumped nearly 50% on average since 2020. For the historic homes on the peninsula, the numbers are even more shocking, with annual premiums often exceeding $10,000. A report from the Post and Courier shows that many private insurers are refusing to renew policies on homes built before 2005, pushing owners toward costly surplus line coverage. Tidal flooding isn't hypothetical here. NOAA data reveals that Charleston experienced a record-breaking 89 days of tidal flooding in a single year, water in the streets for nearly a quarter of the year. This constant saltwater exposure wreaks havoc on foundations and infrastructure. Flood insurance is widely purchased, but under FEMA's Risk Rating 2.0, nearly 90% of policyholders are seeing their rates climb. Research from Climate Central predicts that by 2050, nearly half of Charleston's properties could face annual flood damage, and insurers are already pricing this future risk into today's premiums. Local real estate agents report that insurance contingencies have become the leading reason pending home sales fall through. Some buyers are walking away from deposits rather than pay skyrocketing premiums. In my view, Charleston is locked in a losing battle with the ocean. Its historic architecture is priceless, but the land beneath it is increasingly a liability. Unless you have the means to self-insure, owning a piece of this history is becoming a luxury that fewer and fewer people can afford. Number 4. Baton Rouge, Louisiana. Next, we stay in the Gulf region but head inland to Louisiana's state capital, Baton Rouge. At first glance, being away from the coast might feel like safety, but this city proves that the insurance crisis stretches far beyond the shoreline. Here, the problem isn't just weather, it's a financial system in collapse. After a series of devastating hurricanes, dozens of regional insurers went bankrupt, leaving homeowners with almost no options. The Louisiana Department of Insurance reports that 12 property and casualty companies have become insolvent since 2020. That wave of failures forced over 100,000 families onto Louisiana Citizens, the state-run insurer of last resort. By law, Citizens must price its policies at least 10% higher than the highest private market rate, meaning homeowners are essentially required to pay a penalty just to have coverage. S&P Global data shows that homeowners here have seen premiums jump 63% on average in a single year, with standard policies for modest homes now running $4,000 to $5,000 annually. A survey by Louisiana State University found that 17% of homeowners in the state went completely uninsured because they simply could not afford the cost. A staggering number of people living on the edge of financial ruin. Policy Genius also ranks Louisiana as having the highest combined rates for home and auto insurance in the nation, effectively creating a second mortgage for residents. The risk here is systemic. Reinsurance costs for carriers operating in the area have surged by 50%, making it nearly impossible for new insurers to enter the market. Baton Rouge shows that the system can fail even without a direct Category 5 storm hitting. The financial infrastructure has collapsed, leaving residents to pay for disasters that happened years ago. In this broken market, the only certainty is that your insurance bill will rise again next year. Number 3. Riverside, California. Heading back west, we land in Riverside in the Inland Empire, a city that was once billed as the affordable alternative to Los Angeles. Hundreds of thousands of families moved here to escape sky-high coastal prices, only to find themselves living in a wildfire trap. Riverside sits where sprawling suburbs meet dry, brush-covered hills, creating one of the most volatile insurance markets in the country. The danger isn't just the flames, it's the relentless heat that dries out the landscape, turning fire season into a year-round risk. First Street Foundation projects that Riverside County will see a sharp increase in days with extreme wildfire danger over the next 3 decades. Insurers are paying close attention to these climate models, and they're reacting fast. Policy non-renewals in Riverside zip codes have skyrocketed over 300% in the past 5 years. A staggering triple-digit jump that leaves thousands suddenly without coverage. For many residents, the California FAIR Plan has become the only option. Data from the California Department of Insurance shows that FAIR Plan enrollments in Riverside have surged as private carriers, including State Farm, retreat. But the cost is punishing. What used to be a $1,200 standard policy is now replaced with a FAIR Plan policy exceeding $4,500 annually, often with far less coverage. The risk also hits property values. Redfin reports that nearly 60% of Riverside homes are classified as high fire risk, and many buyers walk away when they see the insurance costs. CoreLogic adds that reconstruction costs in the Inland Empire have risen about 25% due to labor shortages, making claims more expensive and squeezing insurer profit margins to the breaking point. In my view, Riverside represents the cruel irony of the housing market. Families moved here to save on mortgages, only to hand those savings straight to insurance companies. It's a harsh reminder that cheap land often comes with dangerously expensive risks. Number 2. Miami, Florida. Now we head to the Sunshine State, landing in Miami, the flashy heart of what may be the most dramatic insurance collapse in America. Miami is known for beaches, luxury condos, and non-stop glamour. But behind that glossy image sits a deeply unstable insurance market that many experts describe as financially toxic. What makes this crisis different is that it's not driven by nature alone. Hurricanes absolutely pose a threat, but legal battles and fraud have poured gasoline on the fire. When you pay your premium in Miami, you're not just covering wind damage, you're helping fund an avalanche of lawsuits. The Insurance Information Institute reports that Florida accounts for just 9% of all homeowner insurance claims nationwide, yet it generates a staggering 79% of all related lawsuits. That imbalance helps explain why premiums here are the highest in the country. The average Miami homeowner now pays more than $6,000 per year for insurance, roughly 4 times the national average. According to the Florida Office of Insurance Regulation, the state-run insurer, Citizens Property Insurance Corporation, has ballooned to more than 1.4 million policies, making it the largest insurer in Florida. In other words, the company of last resort has become the main option, absorbing risks private carriers refuse to touch. In Miami-Dade County, the private market has thinned dramatically. Over the past 3 years, more than 15 Florida insurers have either stopped writing new policies or gone insolvent altogether. And condo owners are facing an especially painful reality. After new safety regulations followed high-profile building failures, association fees and special assessments have surged. At the exact same time, insurance premiums are exploding. Redfin reports that condo listings in Miami are stacking up, largely because the combined cost of HOA fees and insurance makes ownership unaffordable for typical buyers. In my view, Miami is quickly turning into a playground for the ultra-wealthy, those who can afford to self-insure and absorb the risk. For everyone else, the dream of retiring by the ocean is being swept away by insurance bills that now rival, or even exceed, a monthly mortgage payment. Number 1. New Orleans, Louisiana. We've reached the final stop on our journey, the city that ranks as the most financially uninsurable in America. New Orleans is rich in culture, history, and resilience. But when you look at the numbers, the equation simply no longer adds up. This is a city built below sea level, sitting in a bowl surrounded by water, as the coastline steadily erodes and storms grow more intense each year. What's unfolding here isn't just a challenge, it's an existential crisis. And the insurance market is responding with cold, hard math. The situation has become dire. Under FEMA's Risk Rating 2.0 system, nearly 95% of policyholders in the New Orleans area are seeing their flood premiums increase. For many homeowners, these aren't minor adjustments of a few $100s. They're hikes totaling thousands annually. Local brokers report that flood insurance on some historic properties has surged from around $600 per year to more than $3,000, with built-in increases of up to 18% annually still ahead. On the wind insurance side, the private market has largely disappeared. Following Hurricane Ida, dozens of insurers either collapsed or exited Louisiana altogether, according to the Louisiana Department of Insurance. That mass retreat pushed countless residents into Louisiana Citizens, the state-run insurer of last resort, where policies are legally required to cost more than private market rates. The broader economic consequences are already visible. A report from Greater New Orleans, Inc. identifies soaring insurance premiums as the single biggest threat to the region's economy, fueling rent increases and driving residents away. Policy Genius data suggests that when you combine wind, flood, and liability coverage, insurance expenses in New Orleans can easily consume more than 10% of the median household income. That level of financial strain simply isn't sustainable. Looking ahead, the outlook is even more troubling. First Street Foundation estimates that over 90% of properties in New Orleans face severe flood risk within the next 30 years. With exposure that widespread, underwriting becomes extraordinarily difficult. In my view, New Orleans is the ultimate warning sign for the global insurance industry. It's a beloved city with unmatched character, but from a pure risk management standpoint, it's edging toward unlivable. And here's the harsh reality. If you can't insure a home, you can't secure a mortgage. Without mortgages, the housing market stalls. We've traveled from the hail-scarred Midwest to the wildfire-stricken West and finally to the flood-prone South. The map of uninsurable America is expanding, and your city could be next. This isn't just about extreme weather. It's about the fundamental repricing of risk in the 21st century.